Go ahead.
Is that you're most likely going to be carrying a note, which is a part of the purchase price that you will be carrying. And so having your business in good shape and ready to take off will definitely help you in that situation. We're going to be putting everybody on mute to eliminate any outside noise. And when it's time for the Q&A session, we will unmute the call. We're going to allow 5 to 10 minutes for questions. And I will tell you, if the question is very specific for your industry and not relevant to the rest of the group, we'll let you know and call you offline to be able to discuss that. But if you'd like to send a question in the chat section on your screen, please do so. And then we'll choose a few of those to cover at the end. So let's begin. Okay. I think we all know that at some point every owner is going to either voluntarily or otherwise be exiting their business. So you're going to want to get your business in the best shape so that you can sell it at any time. We really don't know, do we, of what the future holds for us. I've had business owners call and they, got contracted a bad illness or their wife died and they had to sell immediately. So just pretend that that might happen, heaven forbid, but that your company is in the best position to be able to sell at any time. That doesn't necessarily mean the economy will be at the best state, but you will be, and not at the whim of what's going on out there. Okay. We're going to talk, just touch for a few minutes. Eric and I kind of boiled it down to the ingredients of a successful exit before we go through the process. And of course, it's definitely you want your exit plan based on your objectives, not somebody else's. So we're going to go into much detail about how to be very clear on your objectives and who can help you get there. Your objective may be to sell your company and be able to stay on because you really just don't want the responsibilities any longer, but you love the industry. Could also be that you would like money coming in on the monthly basis for your retirement. And we've had sellers we had a dry cleaning chain that sold their business, and they wanted to be the bank. They said, I will be the funder. So they got 20% down. They were 80% funding the business, and they ended up getting $12,000 a month for 10 years to be able to live very comfortably in their retirement. And that was, of course, in addition to their other planning. You definitely need to have a team of advisors that can help you implement your plan. We're going to go into detail about that. We're going to talk about cash flow and a quantitative business value, how important ingredient is having a strong management team, and time. The point about time that I want to make is that the longer you have, the more time you have in planning your exit, the better it will be to implement your strategy for building value drivers, and we're going to talk about those. If you have to sell immediately, of course, you're not going to have as much time to do that, but some of you are probably already prepared. So let's look at the 7 steps to the exit planning process. I'm going to be covering the first 3, talking more about objectives, your personal financial resources, maximizing your business values, and Eric Nielsen will be covering selling your business to third parties, ownership transfer, business continuity, and personal wealth and estate planning. So I think this is 101 in exit strategy planning, is when a man does not know which harbor he's heading for, no wind is the right wind. So as you know, you definitely need to have your goals and objectives in place or you're not going to get there, are you? Okay. Let's see. So step 1, identifying exit objectives. And this is slide 6. So universal objectives. One of the things you need to be asking yourself is how long do you want to work in the business before retiring? And I know last year we got many phone calls from people that had said, well, I was going to be selling this year. They had told us in the past that third quarter, I'm going to be ready. But as we all know, we had a recession last year, and that changed a lot of people's goals and objectives. So now it's added a year or two to their plan. But be thinking, ideally, when would that time be? And then what annual after-tax income do you want during retirement? And that is in today's dollars. This is when you're going to be working with a couple of your advisors to help you figure out how much you do need. I know many people, once they get a valuation, they may be very surprised and say, I need to sell it for $2 million and get $2 million for my business, and it's not positioned to be making that, so it looks like I'm going to be working a little longer. So we're going to go into more detail about that. And then to whom would you like to transfer your business? So many of us think that, one of our kids would love to take over, and you've been trying to get them involved in the business, and maybe they begrudgingly joined you, but that's not necessarily their dream. It's your dream. So you might need to look elsewhere. You may have a partner in your business that you may want to sell it to. That often happens. Key employees. There may be some key employees that you may want to turn the business over to, and Eric will go into the advantages and disadvantages of that. And outside party, which we call a third party, which is very common in the people that we're working with. I love this cartoon. I told my son, one day this will be all yours, and he hasn't spoken to me since. So like I said, just because it's your dream doesn't necessarily mean it's theirs. Working with a team of advisors, I can't emphasize enough how important this is. So many people that are business owners, once we're talking with them about getting started and taking their business to market, and we talk with them about who they need to get on their team, we hear too often that, well, I think I can handle it, or I'm just going to trust you, the intermediary. I don't need an accountant or an attorney. And my advice to you, if any intermediary tells you you do not need an accountant or attorney, run from that broker. You do need them, and you need them desperately to help you get through this. Not only just in doing establishing your exit objectives, but you need them through the transition, and we'll be talking in a few minutes about some other people. Your attorney, who may be your trusted advisor, isn't a transactional attorney. He maybe helped you with a family matter, hopefully not a divorce, or some other issues with property, but this does not mean that he's an expert in transactions. And so you definitely need a transactional attorney. We have many people on our referral list that we can refer to you that this is all they do, because they do have diverse skills and talents, and you need that. The team approach really does minimize risks, but it does cost. We have found that people typically range, depending on the size of the business, from a couple $1,000s to maybe $10,000 to get your team on to help you in the transaction. But it is money well spent. Don't think you can do it alone. Here's a list of the advisors that could be on your team. And, of course, depending on how complex your business is, depending on and the size and whether it's a stock sale versus an asset sale, is going to determine how many of these people. Financial planners, many of you are already working with one. Insurance advisors, they will definitely be a part of it, probably not that big a part. Investment advisor, business attorney is a must, estate planning attorney. If you're selling it for a very nice profit, you're going to want to try to protect as much of the equity that you got out of that as possible. CPA is a must. Value specialist. Depending on the size of your business, your intermediary may be able to value the business for you. We do most of the small ones in-house, but if it's a complex, larger deal, we recommend you having a third party value your company. Investment banker, business or management consultant, and bankers. The banker is mainly going to be working with the buyers, and that's a whole nother topic that we won't cover today, but it is much more difficult right now for banks to lend if your business was down last year. And that's why sellers are becoming the bank and buyers are putting more down for their business because of the economic situation right now. Step 2 is quantifying the business and the personal financial resources. You know, it's interesting. We've seen companies that we've listed without a price, and we often do that for larger businesses because we don't know what that business, how that business is going to be seen in Company A's eyes versus Company B's eyes. We've had businesses where we received 4 offers, and the difference in those offers were amazing. One was a strategic investor who, you know, wanted to add it to what they were already doing. I think there were 2 of those, and the other 2 were just high net worth individuals that wanted it. So what it's worth to one person, because they know where they can take it, it could be a lot higher. So you'll notice if you're ever looking online at listings and what they're going for, you may see call because there's not a price on it for that reason. But getting your business valued is typically your first step in getting started in your exit planning. Even if you don't plan on exiting for 3 to 5 years, you still want to know what your business is worth now. You need that baseline value for projecting. And it's so important, that baseline. I kind of liken it to getting a physical. We're supposed to be getting our physicals annually, or at least every 2 years, and most businesses are doing the same and getting their business valued every 2 years. It definitely can help measure business and personal resources both today and as a base for future projections. Remember, I said that if you thought your business is worth $2 million and you get it valued and it's only worth $1 million, that might let you know that you have to work another year or 2 to get it to that point. It also, of course, allows you to monitor progress towards your stated objectives. Step 3, maximizing and protecting your business value. So you're going to find out what your business is worth, and now you're going to start building value in the business. And we want to, I love this, making a silk purse from a sow's ear. So let's look at some of the benefits to an owner in protecting your business values. Growing a business value, intangible value of the business. So you're not only going to be, we're going to be looking at value drivers in a few minutes, but you're not only going to be doing that, but intangible values of the business. And this could be making sure that your team is equipped to take over and be able to do more than maybe you have them doing now. So that is going to be a big part. And then reducing income taxes upon the sale of the business. It's really not what you get for your business, it's how much you get to keep. And that's where you're going to be working very closely with your CPA and financial planners of how you can protect your hard-earned work in your business. You're going to want to protect assets from potential business and personal creditors and create ability to sell the business. You may be surprised to hear that only 25% of Main Street businesses are able to sell. In fact, that really goes up to, I think, $5 million. I think Eric's going to cover that. The larger businesses get up to 50% of them are able to sell their business. So being able to maximize and protect the value of your company, you will be one of those 25 that are able to sell your business. And I think the stronger your company is, wouldn't you agree that your employees are going to be happier and more motivated to stay on? And that's going to be a key in the value of your business. If a acquiring company sees that your employees have been there for 5 years or 10 years, I can't tell you how important that is in them feeling safe about taking it over. So let's look at how we can promote value through value drivers. Increasing cash flow. We've all heard that cash flow is king, and there's many ways to drive the value of your business that are really not very expensive. One of the things that I know we have done and many other companies have done is they've dropped their yellow page advertising and put that investment into the internet and driving it with search engine optimization with AdWords. We had a live seminar a few weeks ago, and all of our attendees were driven there through the internet, and we had a very good attendance. So you can also, to add cash flow, you can add other product lines or any additional services that you may not be adding. So let's say a printing company may want to add sign making as well and be able to add a few more pieces of equipment, but that's going to make your, you could double your revenue and your cash flow from that. Let's see. And then I think another thing that has been very effective is acquiring other companies to increase revenues. We have a business right now that we're working on that is looking at, it's a machine shop, and he's looking at other companies that he can acquire so that he can help his cash flow to help with his exit in a few years. Some people add sales reps, and of course that could add to your expense unless you're able to get them for commission only. And many people have added to their geographic territory, especially if it was a franchise. You may want to buy another territory. Or if you have sales reps and you're in the South Valley, you may want to put somebody up in the city or the peninsula to help grow your business that way. Also, finding new channels of distribution can be very helpful. That's probably one of the most obvious things that you could do to help get your product or service out there. The next step in promoting value through value drivers is developing operating systems that are going to help sustain this cash flow. Okay, guys, Rolodexes are out. I think most people realize that. So most of you probably have a very strong database, but a Rolodex would not impress our buyers for today. You may need to update your software, but just make it a little easier for a new owner to take over. They're really expecting that, and it will take away from your value. If it's going to be too costly and you want to exit within the next 12 months, it may not pay to put a lot of capital expenditures into your company. But if you're thinking 3 to 5 years out, it would be well worth it to do it now, and they are considered one-time expenses anyway, so you could add that back when we're doing the recasting of your financials. Another easy thing to do to improve operating systems is to improve your customer service. It's one of the surest ways to keep cash flows positive. And, this could just mean giving extra training to your employees because if you don't have an edge on customer service, your business isn't very valuable anyway, is it? So maybe that can just be the one differentiator in your company versus your competitors. I know there's a few people on the call today that have a lot of competition out there, and you need to differentiate yourself, and customer service is such an easy one to do. You want to solidify and diversify your customer base. This is another deal killer for many buyers. I know we had a business once, and it just happened to turn out well, but it could have really been a detriment to the sale of the company. They had 75% of the revenue coming from one or two accounts. Would you feel very safe as an acquiring company coming in and just hoping that company stayed on? Well, what they did to eliminate that problem is the seller said he would stay on for 3 years as a salesperson, and he really loved that idea because he really liked the business, he liked the industry, he enjoyed sales, and that was really what he was very good at, but he didn't have time when he was doing so much of the operations of the business. So it has worked out very well. It was a 2-year contract, and he stayed on. It's now going in the 4th year. So that definitely helped the earn-out, which was a part of the terms of the transaction. And so the seller was paid on his earn-out due to the buyer staying on and ensuring that those 2 accounts are there, and they are, and they have now, it's down to 60% of the revenue, and they're going to be maybe 40 to 45%. And they've added a lot since then. The rule of thumb is you want your revenues from one source or one company to be less than 20%, and I really get excited when they're all under 10%. The next step to take in promoting Your value drivers is implementing strategies to grow the company, and I think we mentioned that adding lines, territory, acquiring other companies, that pretty much covers that. Improving company's performance as measured by the industry metrics, and then building a strong management team to groom a successor. I can't emphasize, there are so many companies that we get calls from, and I ask them to describe the structure of their company, and they'll say, well, Joan, it's pretty much just about me, and so I call that it's all about Bob syndrome, and Bob has had a very difficult time delegating and adding employees to his company, and he's doing everything. So I would say that's one of the things you need to make sure you're not doing is everything, and add other people to make the acquiring company feel much safer and to be able to carry on as you were doing. And I know it's difficult, and maybe the first year you want to be doing a lot, but that's one of the first things you should be thinking about is how you're going to grow your company through building management team. Here's a cute cartoon. I stuck it to you if it didn't mean a row with your mother when we got home. So often the family dynamics can be difficult, and it can be very difficult when you're trying to exit if you do have a lot of family members involved. Buyers always ask any other family members because they know typically if you have your son or your daughter, they often want to leave when you leave. And then there's other family dynamics that they really want you to leave and they want to stay, but they don't have the money to be able to buy the business. It is now time for me to turn this over to Eric Nielsen, our senior intermediary with Sunbelt. And so, Eric, are you there?
I'm here. Thank you, Joan.
Great.
Well, welcome, everybody. Thank you, Joan, for your insights on the first half of this webinar. I'd like to pick this up. Joan talked about some of the objectives, and she talked about, where you want to go, financial goals, and timing, when you want to get there. But really what I want to talk about now is kind of the who. Who do you want to succeed you or be your successor in this business? Who do you want to transfer ownership to? And when we think about that, I think about there was a song Paul Simon did some years ago called 50 Ways to Leave Your Lover. And there are a myriad of ways to exit your business. And I kind of lump them into some categories. Obviously we can talk about some high-level stuff, IPOs, and I don't think that really applies to our audience today. Liquidation is another way to exit, and it would be my hope that everybody listening today is planning and positioning for a successful exit that would be something other than a liquidation. So that leaves us with ownership transfers to third parties and or transfers to what I call insiders. So these steps 4 and 5 kind of are an either or in the planning process. Once you've identified your best exit strategy, the who will be either transfer to third party or inside. So let's talk about those for a minute. Third-party transfers can be to high net worth individuals, private investment groups or equity groups, strategic buyers, other companies out in the marketplace. And they all have their merits and their pluses and negatives. So let's talk about some of the benefits to transferring to a third party. Obviously, cash at closing. This is a big one. Kind of in today's marketplace, maybe a little less cash, a little more on the note side or earn out. Certainly at peak of M&A cycles, we're going to see more cash coming at close. And this, really allows us to eliminate some risk in getting out. You're going to get most of your cash up front and a note and collect payments. And it's just a less riskier proposition. The family succession issues. How many business owners are looking at being equitable with their estate planning to their children, spouse, and this will eliminate some of the complexities involved with the estate planning and exit. And then, of course, speed of exit. This is a big one. It's a done deal. You close. You may be around on a consulting agreement or a transition period, but for the most part, you're going to turn the reins over to new ownership and be done with the deal. So it's not just about the business. There's some factors at play that are going to determine your ability to sell to a third party and maximize that financial goal at the end. And the three: intrinsic value, extrinsic value, and effectiveness of the sales process. Now, Joan has spent a great deal of time going over some of the value drivers in the intrinsic value that you can create in your business, and you have a great deal of control over that. You can spend time planning and building that value, and really maximize your financial rewards at the end of the process. I like to use an example. I was working with a equipment rental company, and they had done a tremendous job of building value, well-diversified client base. They had financial controls in place, good accounting and reporting, and they had put a management team on the ground that could operate the business for them quite nicely, and they were able to exit quickly for the amount of money they wanted, and had multiple buyers looking at their business, and it was really a good deal for them. They've done a great job on it. So would like to, through these seminars and other education, encourage owners to try to position themselves that way. Extrinsic value, this is one that's a little tougher to control. And what are the factors at play in extrinsic value? You've got the external market variables. So the M&A cycle, it's a cyclical type of deal, and you may have a business with all the value drivers in place, revenues and profits, and you could secure quite a different price for it at the bottom of an M&A cycle than you would for the same profile at the top of the cycle. So M&A can be cyclical. So what are the influences there? Obviously, the state of the economy, availability of capital, interest rates, tax rates can play a part, and geopolitical events. We saw some of the M&A cycles drop to lows right after 9/11. So these can all create uncertainties in the minds of buyers and affect the M&A cycle. What are some of the other influences? There's always an industry-specific component. As you can imagine right now, the construction industry is struggling. So if you have a business in that industry, the timing is bad for you. But conversely, people with businesses in the healthcare industry, obviously solar or any green businesses, these are all getting a lot more attention in the marketplace, and may have better values. How can you control the extrinsic values? Well, Joan touched on a little bit earlier. There's really not much you can do. You can either wait if you're not where you want to be, or if you are where you want to be, you can move quickly. So those are the only two things you can do. And if you're waiting, of course, you can spend some time, working to increase your intrinsic value. I worked with one company. It was a trucking company, and the owner was ready to exit, and he knew that within his industry there were some strategic buyers who wanted what he had, and he knew the timing was right. And while his company wasn't, it's trucking, there's a lot of competition. He wasn't, his financial performance was solid, but it wasn't, something that really got a lot of attention from financial buyers. But he had some clients and some routes that another trucking company desperately wanted. So this is an extrinsic value for him. The outside value to this company was higher than it would be for most buyers, and he was able to sell at a very nice profit and make a very nice deal. I'll come back to the M&A cycle in a minute, but I want to move now to the effectiveness of the sale process. And this is all about getting the right team members on board when you're contemplating a third-party sale. And there's really kind of a few steps to an effective sales process. I boil this down to pre-sale planning. This is or pre-sale due diligence, as it's referred to by a lot in the industry. Marketing and finding buyers, negotiating the sale, and then handling the details of the close. So going back to the pre-sale planning, it's wise to get your intermediary involved early because you're going to be able to take a look at your business and guide you in terms of where your value drivers are and how your business might look to the marketplace. And I like to use an example. We had a transaction in the office a couple years back. It was a machine shop, was making quite a bit of money, but one of the big warts that surfaced early on was that their accounting was kind of a mess. And so we went in there and said, look, we can see that you're making money, but it's going to be very difficult to explain this to any outside buyers. So we spent some time with them, brought in an outside accountant, got their books cleaned up and presentable, got their tax filing squared away, and spent a fair amount of time getting this done. And when the company was ready to go to market, it was much easier to tell their story and to have all the data in place to back it up. Marketing and finding buyers. I can't tell you how many owners I talk to who say, yeah, I might be interested in selling, bring me a buyer, and we'll contemplate a sale. And they don't realize what a disservice they're doing to themselves at this point. If you have a single buyer in your transaction, by and large, they're going to control the negotiations. They're going to control the process, and it's really not going to be the best possible outcome for business owners in terms of structuring a deal. Conversely, if you can create a limited or controlled auction scenario where you go to market, you contact multiple buyers, you get multiple buyers interested, this is going to do a couple of things for you. It's going to support the value and the price that you have on the business, and it's also going to expedite the process. If buyers know there are other buyers waiting to buy your business, they're more likely to step up, move the process along, and be a little bit more aggressive with their price and terms. So I can't overstate the benefits of that process enough. So get a good intermediary on your team. They know how to create this scenario, and they can do the best for you for your for financial objectives. Let's move on to the M&A cycle a little bit. I want to talk a little bit about that because I think it's important to understand the timing. You can see here, these are some statistics that were put forth by Tom West, who publishes Business Reference Guide. They're about 5 years old, so they're a little out of date, and Joan touched on these. 20% of businesses for sale, only 1 out of 4 sells. Businesses with sales of $10 million, 1 in 3, above $10 million, 50-50. Those numbers may have actually dropped a little in the last couple of years as we've been in the midst of this recession, but it's kind of interesting to talk a little bit about the cycle because the M&A or business sales kind of go in cycles. So let's talk for a minute about where we've been. If we can look back 10 years, I think back when the dot-com bubble burst and we had the 9/11 attacks, the M&A cycles were relatively low. And then we all know what happened after that. The Feds lowered interest rates, and we had a lot of money flowing around the economy through through financing of real estate, and we kind of peaked at 2007. Subprime debacle hit, and the cycle of course, trended back down. So where are we today, and what's the outlook? I'm going to read from you a little bit of something that came out of KPMG, and they suggest that there's going to be a significant increase in M&A appetite during 2010, but the increase will come mostly from strategic buyers, not private equity or high net worth. And the study went on to identify changes over time that are going to affect the appetite and capacity for deals. They indicated that most of the activity come from corporate buyers, strategic acquisitions. There'll be some resurgence of private equity, and the financial buyers will continue to be constrained by a shortage of debt, which puts them at a competitive disadvantage over the strategic buyers. So where are we headed? Well, I think KPMG suggests that there's going to be an uptick in the M&A cycle, but let's look out a little further. And I think one of the things that as business owners you really need to be aware of is this thing called the baby boomer generation. So it's no secret. We all know that as boomers we're reaching the retirement age, and what does that mean for the M&A cycle? And some estimates say that there are about 7 million business owners that are going to exit their businesses over the next 5, 10, 15 years. And this is estimated to represent about $10 trillion in wealth. So it's going to be a huge transfer of wealth. And what's that mean for business owners today? Well, there's going to be a large supply of businesses coming online, and going back to Economics 101, we all know about supply and demand and what that might mean. I think the other thing that was kind of striking to me was a couple of people, Price Waterhouse and Marquette Universities, have done some studies on this this phenomenon that's going to take place, and what they found is that 75% of these business owners don't have any idea how to handle what perhaps will be the single most important financial decision of their lives. So that's why we kind of want to reach out to people and get them aware of this planning process so that they can be aware of the cycles, be aware of how to manipulate their companies and build value, and be ready. Let's turn now to some discussion about transfer to insiders. And what does that mean, an insider? Well, Joan touched on it a little bit. That can be co-ownership if you're in a partnership or have equity partners. It can mean a key employee group, and often it means transferring ownership to family members, primarily children, second generation, third generation businesses. So what are the benefits of transfer to insiders? Well, obviously, a strong objective for family people is to transfer their ownership to children. This creates a legacy for them, and they like to see the business go on. In the case of key employee groups, or kegs as I like to call them, and sometimes they're a powder keg, but this can motivate employees. You can give them a small percentage of equity to motivate them going forward. And planning can reduce your risk in the amounts of money, increase the amounts of money that you will receive if you plan properly. What are some of the disadvantages? Well, there's considerable financial risk. Typically, whether it's your key employee group or co-owners or children, they really don't have any cash to give you at the time of a transfer. So they're going to rely on the future cash flows of the business to pay you or buy you out. You may lose control before the buyout is complete. Can also cause some family friction. There's going to be questions revolving around income and equitable distribution of your estate. And good employees and family members may not always make good owners. I want to tell you a little story about a company I worked with that was vacillating between a third-party sale and a family transfer. And ultimately, they decided to transfer to the insiders. They had gifted over some of the business to a son and a brother-in-law, and they were transitioning out and taking pre-tax cash via some equipment leases, facility leases, some consulting income, and other perks, which is smart. They were minimizing their tax bite and legally. And eventually they sold the balance of the company via a note to the son and the brother-in-law and relinquished total control of the company. And within 24 months or so, business declined. It eventually collapsed. Their cash flow and their business value were gone. So, one could argue maybe they didn't train these people well, but the reality was that their financial objectives weren't met, and it left them in kind of a difficult situation. Let's talk a little bit about continuity planning. This is often overlooked by business owners, and this is really an important step to include in your planning as you go forward. By and large, as business owners, we're good at contingency planning, but few of us plan for one thing that's certain, and that's an eventual death or disability. I know it's sometimes an uncomfortable topic, but only two things certain in life: death and taxes. So we have to be aware that this is a possibility. And I think probably the primary thing to think about is the continuity of leadership. If your ownership transition is uncertain and your business continuity is threatened by your untimely departure, it could have some really negative effects on your company and your family. So you've got to take some steps to try to maintain some continuity. I can give you another little case study. This is kind of a sad story, but I think it illustrates the point. I was working with a business owner who had a software company, and he had a plan. He was working through it, building value. He was, had targeted 12 to 24 months to get his company where he wanted it to be, so that it would be saleable to meet his objectives. And he was tragically killed in a traffic accident, and it was a pretty big blow to the company. Well, he hadn't got his contingency plans in place for this type of event, and so the future became kind of uncertain to not only his employees but some of his customers. A couple of key employees ended up leaving. The firm's ability to deliver on some of its promises, were impaired. They experienced a drop in revenues, and after six months or so, the bank grew uneasy, called the debt, and the company basically had no value to a third party, wasn't saleable, and eventually it closed. And it's really sad. There's some things that I think could have been done to help mitigate that eventuality. So, what are some of the methods to avoid this kind of collapse? I think if you can put together some written instructions about what you want to have happen if you exit untimely, I think this goes a long way. Communicate these instructions with your advisors, your co-owners, your family. Put some stay bonuses in place, so key employees will have incentive to stay if you're gone. You can fund some of these events with life insurance or disability insurance, and make sure if you have co-owners, make sure your buy-sell agreements are in place. I think that's very important and often overlooked. I've met with numerous business owners where there's two owners, and I ask them about their buy-sell agreement, and they say, "Well, we haven't gotten around to that yet." And so I think that's it's pretty key. So what are the benefits? Obviously, your objectives can still be achieved if you don't survive your exit. It's going to provide for some ownership control. If a co-owner departs, buy-sells can have non-contributing owners leave the business. Consistency between your lifetime and death benefits. If you're working on an estate plan, you can make sure that these dovetail together. I think this is a big one, the survival of the business for the benefits of others. If your spouse or children, if the business is a big part of your estate planning, you certainly don't want it to collapse and lose its value. So at the very least, your plan should include provisions for management control, a plan for disposition if your wishes are to have the company sold. You need to let that be known. Communicate who your advisors are. And this sounds funny, but a lot of times business owners don't share this stuff with their family or their others important in their life. A list of possible buyers. You may have been talking with some buyers over the course of your business life, and you may just want to jot those down so somebody can say, hey, these are some people that are interested. And then your personal goals going forward, if you should reach an untimely demise, what were your goals in that case, so that that can be communicated to your family. In the last step, personal wealth and estate planning, this kind of comes full circle. I would strongly suggest at the beginning of this planning process that you be working with a financial planner to obtain or determine your financial exit objectives. I love this quote by Bill Shakespeare: "When the slings and arrows of outrageous fortune befall you, fight back." You're going to have a lot of decisions to make about estate planning and taxes and whatnot, and you've got to make sure that you have this integrated into your overall exit plan. Obviously, preserving wealth, minimizing taxes, both during your lifetime and after death are things you want to consider. Integrate your lifetime objectives with the estate plan in terms of business exit. And so really they become integrated, the exit planning. For most business owners I talk with, the business is a considerable part of their net worth, if not a considerable part. A lot of people are diversified, but it's a huge asset in your estate, and so any exit planning should be dovetailed with your estate plans. So I'll end the presentation with a restatement. At some point, every owner leaves his or her business, voluntarily or otherwise. And at that time, I think it's reasonable to assume everybody would like to receive a maximum amount of money for their personal and financial goals, income and estate planning goals. I want to thank everybody today. Joan, I'll turn it back over to you for a minute.
Thank you so much, Eric. That was very informative. Hope everybody got quite a bit out of that. We've gotten a few questions in, and it's interesting. Most of them are going to be in our following webinars that will be coming up in the next few months. One was a question on, let's see, what was this one? What do buyers look for and what's important to them? And that was sent in by Julie, and we're going to be able to cover that. We've gotten quite a few questions on valuations, which is totally a webinar on its own, and we're going to be covering that. So I really appreciate all of your participation, and we'll definitely give you at least a 7 to 10 day warning of our next one, our invitation. And so please feel free to call Eric or myself at any time. Our office number is 408-436-1900. Have a wonderful day. Thanks so much. Bye-bye.
Thank you. Please stand by.